our ongoing cost optimization initiative, implementation of our direct distribution model, grammage rationalization along with higher price realizations. Additionally, we have also accelerated implementation of our direct distribution model strategy across all regions and completed it ahead of schedule. This, along with our cost mitigation measures, assisted us in restricting the impact on our margin during the quarter and full year. Let me now quickly take you through our financial performance during the quarter and financial year ended 31st March 22. In Q4 revenues grew by 17% year-on-year at rupees 3614.6 million. EBITDA stood at 49.4 million when compared to rupees 139.2 million in Q4 21. PAT during the quarter was at 29.5 million as against 71.3 million. In the year, revenue grew by 19% year-on-year to 13966.2 million. Operating EBITDA stood at 583.1 million, translating to a margin of 4.2%. PAT, excluding the exceptional item due to loss by fire at Kolkata plant, stood at 169.1 million. On the demand front, with normalization in activities, increase in travel and the reopening of economy, we are pleased to share that the footfall in our touchpoints have nearly touched pre-COVID levels. As I had alluded earlier, our existing retail touchpoints have completely reopened and we continue to add newer touchpoints in key geographies. These new touchpoints have helped us significantly increase offtake. With the new academic year starting from June, we remain confident that the demand of our key products will surpass their previous benchmarks. In view of the resilient performance, the Board of Directors has recommended a dividend of rupees 0.5 per share on a face value of rupees 5 per share. The government has undertaken several initiatives to boost food manufacturing and local production within the country. In one such step, in 21, the center announced the PLI scheme for the food processing sector with an outlay of 10,900 crores. The scheme is aimed at augmenting domestic manufacturing capacity of the food processing industry and also at attracting.
Members of the management, we cannot hear you at the moment. Ladies and gentlemen, we would request you to please stay connected while we check the audio for the management. Ladies and gentlemen, thank you for patiently waiting. We have the management reconnected. Over to you, sir.
Thank you. The government has undertaken several initiatives to boost food manufacturing and local production within the country. In one such step, in 2021, the center announced the PLI scheme for the food processing sector with an outlay of 10,900 crore. The scheme is aimed at augmenting domestic manufacturing capacity of the food processing industry and also at attracting investments in the sector.
The scheme covers four main segments such as ready-to-cook or ready-to-eat foods, processed fruits and vegetables, with incentives linked to local production and sale of products. In December 21, we secured under ready-to-eat category and have we received approval.
Sorry to interrupt you, sir, but your voice is breaking up.
Okay.
Sir, over to you.
On the capex front, the investment commitment aggregates to roughly around rupees 105 crore, of which we have already invested rupees 20 crore. The balance of rupees 85 crore will be invested between us and our contract manufacturing partners by end of 23. To summarize, we have delivered an encouraging performance in the fourth quarter and in 22 given the backdrop of unprecedented macro challenges. With nearly year-on-year growth in the high teens, we have outpaced the growth of industry. We believe we can grow even faster in the quarter ahead with the onset of normalization as well as our strategic business initiatives to enhance our distribution network in terms of scale and effectiveness. However, the outlook for raw material prices remains challenging and we are seeing severe pressure on our margins due to unusual rise in prices of key inputs. The outlook for the immediate terms remains constrained by the disruption in global supply chains, a spike in several soft commodities and agri products due to Russia-Ukraine war, and the rising prices of palm oil following the ban on exports by Indonesia. As a result, we see continued pressure in the immediate term. There is some improvement expected over the medium term as steps taken by the government to alleviate inflationary pressures are expected to contribute to cooling down in prices of soft commodities. Further, the reduction in excise duties on fuel announced should help to alleviate some of the inflationary pressures. Further, Indonesia has lifted the export ban and there are also several steps being taken to develop alternate cooking oils which are expected to lead to reduced prices of palm oil in the future. There has been a tremendous amount of effort to address the challenges and the structural changes that we have undertaken in the businesses have definitely elevated the margin profile of the business. This has helped to partially offset the severe impact of rising inputs and we are working towards driving further gains even in the current scenario of unusually high input prices. We believe these efforts will be more visible over the medium term as the macro environmental normalizes. We remain very confident of delivering higher growth in the quarters to come, which supported by our efforts to structurally enhance margins should also enable us to accelerate shareholder value creation going ahead. On that note, I conclude my remarks and we can open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashutosh from Systematics. Please go ahead.
Yeah, hello, good evening, sir. So thanks for the opportunity. So my question is on direct distribution. So you mentioned that it has been implemented in all the regions ahead of schedule. Can you give more clarity on that? Like as far as I know, it was implemented in Delhi, and then I think the pilot run was going on in Mumbai. So if you can highlight how the plan has actually shaped up, so that we see.
Sorry to interrupt, Ashutosh. Your voice is breaking up. We cannot hear you clearly.
Yeah. So I'm saying that on direct distribution, the management has highlighted that it has been implemented in all regions ahead of schedule. So if the management can clarify on that, like as I know it was implemented in Delhi and then I think pilot run was going on in Mumbai. So if this management can clearly highlight like in which all regions this has been implemented. And actually on the retail footprint, so the company has already added expanded the footprint. What would be the target for FY23? And lastly, on the palm oil, you highlighted that Indonesia has lifted the ban. So going forward, we expect some kind of moderation in the prices going ahead. So if you can highlight like what kind of margin range you expect going forward, that would be really helpful. That's it from my side. Thank you.
Thanks, Ashutosh. Let me take the first question first. Basically, on the direct distribution side, we started with MP first and then we did in Delhi. But with the spur in the raw material prices, we thought that we have to take some severe actions. And at one go, we implemented across the country. There was some pressure from our super stockist and the channel margin and the sales people, but eventually we got everything done. So as of today, 99% of our sales are through direct distributions or super distributors. So there is a difference between super distributor and super stockist. The super, like if you take example of Delhi, we used to have one super stockist and 110 distributors under them. Now we have around 25 delivery points in Delhi. These all are our super distributors. They do the retailing on their own and they supply to the smaller distributor if required. So our net channel margin, which used to be around 14% for Delhi, has come down to almost 10% now. And it has been implemented across the country. There are few exceptions, but probably everything will get settled probably next 1 or 2 months' time. On the third question of palm oil prices, palm oil basically hit very high because of the COVID period when labor were not available in Indonesia and Malaysia. And then the prices across the globe started going up. So if you see our last year price, probably average would be around 70 rupees last 5 year average, which is currently at more than 150 rupees. But with the labor the labor availability going up in Malaysia and Indonesia is starting to export against the stock, I personally feel that prices should go down considerably, probably even 10 to 20% in next 3 months' time. On the EBITDA front, probably Sumit can take that question and answer.
Yeah, hi Ashutosh. On the EBITDA side, as you know, it's a highly volatile situation as far as the raw material pricing are concerned, and it's really very difficult to predict as of now how the prices would move in near terms. So short term, there may be some volatility. However, looks like the prices will definitely come down, as Indonesia has also lifted the ban on exports. So in medium to longer term, we are pretty much confident to expansion in the margin. However, in short term, there may be some pressure, which is being mitigated through various process initiatives.
Okay, fine, sir. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question at this time. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Thanks for the opportunity. Sir, this year we have ended with the top line of around 1383 crores on a consolidated level. Even the schools will have hopefully no further COVID waves, and this will be like the 2 years after COVID that schools will also be starting for the entire year. So how do you think the growth will pan out for the company at consolidated level for FY22?
I think we are targeting in high teens. Definitely should be much better than what we have been doing for last 2-3 years. 2-3 years have been exceptionally bad. Probably the growth rate was bad, but this year definitely it could be much better. It could be in the range of 20.
Okay, then that's good to hear. Sir, secondly, on the grammage front, the industry has been going through a very tough times. Even the industry leaders are facing the challenges on the margin front. And so, do you think, has there been any initiatives taken for reduction of grammage, especially in a 5 rupee and 10 rupee pack? And how do you see the competitive intensity going forward, given such high raw material price increase?
If you see the overall impact in the EBITDA margin is probably very, very high. It should be close to 10 to 12%. So we have done many changes. Out of that, one change has been the grammages changes. the impact of that is not much. We have reduced by 1 or 2 grams in the 5 rupee pack in most of the categories. But the major impact by which we could mitigate this higher prices was through the channel margin and through the PTR. We have increased the price to the retailer and reduced the channel margin. And we have also done some optimization at the factory level, which has also given us 1% extra margin. So there were 3 main levers: optimization at the plant level, second, increasing the PTR, that the price to retailer, reducing channel margin, and fourth was grammage reduction. So we have done little bit grammage reduction across the category.
So and when was this grammage reduction done?
This was done probably in last 30 to 45 days.
Okay. And in fact, last 6 months, how much grammage have we reduced on an average, let's say in a 5 rupee packet?
I think it should be in the range of 5%, 5 to 6%.
Okay, but the the raw material spike has been, the palm oil prices have more than doubled in FY22. So do you think there is further scope for reduction in grammage in coming few months?
I think with all the changes what we have done, we have almost come to our past pre-COVID levels as far as margins are concerned. Though it will take some time to implement, because if you reduce the pack size, you reduce the changes, you reduce the grammage, it will take some time. But I think going forward, raw material prices can only come down from here. It is very difficult for the prices to go further up. At least we are assuming that.
Okay. But okay. In fact, with all the measures that we have taken on, January front and at the plant level, when the raw material prices stabilize or come down, what can be the steady state EBITDA margin that we can target over the next 2-3 years?
And definitely we are targeting double-digit margin.
Okay. That's good to hear. I wish you all the best. And sir, last question.
With all the changes we have done, it would be very difficult for us not to get a double-digit EBITDA margin if the raw material prices improve a little bit also.
Sure, sir. And sir, when do you think that the gross margin compression that we have seen in the past 2-3 quarters, given the prices currently and some of the steps by the Indonesian government as well as hopefully some reduction in prices should happen over the next few days or in the coming months. When do you think that we can come back to our earlier gross margin level of around 28-30%? Or which quarter do you expect that to happen?
Yeah, certainly with increase in the margin and better realization, definitely there will be expansion in the gross margin. However, it also depends on the reversal of the raw material pricing. So any reversal in the raw material pricing definitely will help us to improve our gross margin. And we can reach to the previous range of gross margin, which was somewhere between 30 to 32%.
Sure. So can we expect that it will, hopefully the prices stabilize now, there should be some improvement in gross margin from Q2, or you think the first half itself has been badly impacted? Because Q1, we know that there has been significant pressure on the gross margin. Do you think there can be some improvement from Q2 onwards?
Yeah, we hope for this.
Sure. And sir, lastly on Awadh, the growth that we have seen in Awadh over the post-acquisition hasn't been that much. Last year also, if you look at it, the growth in Awadh has been less than 10% of our, it has hardly grown in high single digits. So how do you see Awadh growth going forward? And I think we had made some management changes as well in Awadh. So do you think how can we grow at higher growth rates in Awadh going forward?
If you see, Awadh was a super value brand compared to all other value brand in the country. With the higher raw material pricing, the impact in Awadh was much higher than compared to all other companies. So we were forced to reduce the weight considerably in Awadh compared to our yellow diamond products. So they were definitely hit in the market. But going forward, we have changed the complete strategy in Awadh as far as sales is concerned. We appointed a full sales staff who taken a new team on board, and we definitely expect it to grow in the line of YD, yellow diamond only. We are looking at a high teens growth in Awadh also this year.
Sure. So Awadh will also grow in line with the overall company level growth of, let's say, high teens or 20% that we are expecting.
Yes, definitely.
Okay. Thank you, sir, and wish you all the best.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and one. The next question is from the line of Rishabh Singh, an individual investor. Please go ahead.
Hello. Yeah, hi, good evening. So, you mentioned that you've had to cut channel margins and increase PTR ahead of schedule to manage increase in high input costs. So, I just wanted to understand if there has been any negative impact on sales because of this. And if it has been, how long would you see it continue?
So there was some impact in few places where the distributor basically they decided not to work with us. There was some impact where we could not supply to the distributor directly. But if you see the major sales come from supplying to the retailer and offtake from the retail point. So there was no problem in that point. So most of the places there was no problem. There was some problem at one or two places, and few places the sales have increased because of this. I don't see any problem in direct distribution as far as sales is concerned. There is a temporary impact of supplying the stock directly to the distributors.
Okay, that's great. Thank you.
Okay.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. The next question is from the line of Akhil Parekh from Centrum Broking. Please go ahead.
Hi. Thanks for the opportunity and congratulations on the progress that we have made so far. My first question is on the contribution from 5 rupee pack. Where do we stand at the end of FY22 and what are the steps we are taking basically to move away from impulse purchases?
So I think our contribution from 5 rupees is close to 90% today. And our target is to take this 10% to 25% in next 2 to 3 years' time.
Okay. And what are any concrete steps we are taking basically to move away from this 5 rupee pack?
There are two things we have done. Basically, we have appointed sales staff who will directly go on A and B class outlet who primarily sells only 10 rupee product. And secondly, we have forced all the distributors to take minimum 10 rupees inventory. Some percentage somewhere where it was 5%, we have forced them to get to 10% so that the sales can increase. So these are the two steps we have taken to increase sales beyond 5 rupees MRP.
Okay. And any numbers you can highlight, like in terms of our penetration in Class A and Class B outlets, where do we stand right now?
I don't think we have that exact number. On the urban and rural graph, we have a number of around almost 50% urban and 50% rural. In A and B class outlet in urban, it is very difficult to give the number. But I think our presence has much better scope to improve in an A and B class outlet.
Okay. And second, Awadh Snacks. Awadh is very strong in Gujarat. How have we done in terms of increasing the reach in terms of the nearby geographies, basically?
So, Awadh basically we have started in parts of Maharashtra and parts of Rajasthan and parts of MP. Due to higher logistic costs and the bigger pack, it became very difficult with the increased raw material pricing. So, we have made different packets for outside region of Gujarat. And we are relaunching Maharashtra, Rajasthan and MP again in Awadh. We hope that at least we can get 30 to 35% sales outside of Gujarat in probably a year or two.
Okay, and right now it would be at?
I think 15-17%.
Got it. And any qualitative feedback you can share about the product in the new geographies which we are trying at, like Maharashtra, Rajasthan and MP?
Basically, Awadh is primarily in namkeen and pellets only. We are also putting up extruded line in Awadh Rajkot. So I think all the products basically are similar, but basically when you go outside the geography of Gujarat and you have to supply in 500-600 kilometer radius, the transportation cost is very high. So we are trying to cut down little bit grammages and on the pack size so that we can supply viability to all these places.
Okay, got it. That's all from my side and best luck for coming quarters.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and one. The next question is from the line of Mayank Vaswani from CDR India. Please go ahead.
Thank you, Margaret. Sir, more of a suggestion than a question. Sir, in Amitji's opening remarks, there was a bit of unclear line, so we couldn't hear the comments on the PLI scheme. So I would request if the management could just, share some comments on the PLI scheme and the related capex over the next year or so. Thank you.
Yeah, thanks, Mayank, for highlighting this PLI-related stuff. So we got the approval under the PLI scheme from the Ministry of Food Processing. The PLI, as per the PLI scheme, there is a base year which is FY19-20, and whatever sales, whatever incremental sales we have over the base year, we'll be getting the incentive as per the PLI policy. The base year, the PLI scheme is for 6 years from FY22 to FY27. For first 4 years, the base year will be FY19-20. For FY26, the base year would be FY22. For FY27, base year would be FY23. The incentive rate for first 4 years is 7.5% of the incremental sale. For fifth year, it's a 6.75%. Seventh year, it's a 6%. We are committed to invest almost 105 crores under the PLI scheme for capacity expansion. We already invested 20 crore in FY22, and around 85 crore we are going to invest in the current financial year in the combination of exclusive 3P operations and our own investment.
Thank you, sir. That was very helpful. I'm done with my questions.
Thank you, Mike.
Thank you. The next question is from the line of Nilesh Shah from Envision Capital. Please go ahead.
Yeah, thanks for the opportunity. My question is on the growth outlook. How do we see demand really playing out on the ground? I mean, given that there are inflationary pressures which is impacting consumer sentiment, do you think this is impacting a category like ours? I understand it's like a low price category and a slightly more value pack, and it does not require large amounts in terms of spending. But do we think that in any way consumer demand is impacted? Because there are media reports which suggest that the overall FMCG sector has got impacted. So just want to understand your experience in recent times in terms of consumer demand.
Till date, we haven't seen any impact of the inflationary pressure on our demand. Our demand basically only comes down when the schools are closed. Probably people can't move around. With the current scenario, when the schools have opened and there is no shutdown, hopefully there is no other shutdown in the country, I don't see any problem in demand in our category at least.
Okay. Just to add on, Amitji, sorry. Again, sure. In this inflationary scenario, we are getting the advantage of down trading. So since it's a lower price point, the 5 rupee and 10 rupee, so we are also getting the advantage of down trading. So we are not seeing any negative impact on the demand side, specifically for our kind of product and price point.
Okay. The second question is on our margins. So, I understand in the short term, of course, margins can be under the pressure, but we seem to be confident of getting into double-digit EBITDA margins when, the situation normalizes. Now, if I were to kind of historically look at our margins, EBITDA margins, they've been in a range of 5 to 9% for several years. And given that our category is competitive, what gives us the confidence that we can, break out of this range of, single-digit EBITDA margin to whatever the low double-digit EBITDA margin? I understand we have taken certain productivity measures, efficiency measures, rationalized distribution, all of that. But given that we are in a competitive category, don't you think at some point of time competitive pressures will catch up, which will in a way somewhere cap our EBITDA margins even over the medium term?
I think it's a real good question. But if you see, I have said in my remark also, basically, we have done 4 changes to improve our margin. The first and the second changes were reducing the channel margin and increasing the PTR. So these 2 margins have nothing to do with the competition. Because if we remove the super stockers and if we can save, let's say 2 to 3% from the channel margin and 1 or 2% from the PTR, that doesn't affect the competitiveness in the market. Any other changes like reducing the weight probably will have impact on the competition, but these 2 changes by reducing the channel margin and increasing the price to retailer has no impact on competition. So I believe these were the inefficiencies for last many years which we have been able to remove now.
Okay. Thank you so much and good luck.
Thank you.
Thank you. The next question is from the line of Kunal Patel from Equilligence Capital Advisors. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir,
Sorry to interrupt you, Mr. Patel. Your audio is not clear. I would request you to come on the handset mode and ask your question.
Sir, my first question is regarding our distribution model again. So, by when can we streamline our distribution model completely like we have done in Delhi? Is it possible to replicate it in other states? And do you see overall this will add up to around 200-300 basis points to our margins?
I think, as I said earlier also, we have implemented this across the country, except with exception of few places. It's already being done. With so much pressure because of the raw material pricing, one fine day we decided 2 months back that there is no way going back and we have to implement it across the country, and we did it.
Okay.
It was done in a phased manner. So initially we started with North India and Western market, and then we have rolled it out to Eastern and Southern market. The expansion of the direct distribution in Eastern and Southern market was done in Q4, more precisely somewhere around March month. So the full benefit of that saving will reflect in Q1 onwards.
Okay. Sir, my second question is regarding newer geographies. So how has been the response in some of our newer geographies that we have entered in last couple of quarters? Also, are we seeing any success there, and how are we planning to scale up the business in those states, in those areas?
Yeah, as we said probably in our earlier conversation that we are trying to expand market in UP, Punjab and South India. So UP we are seeing very good results, especially in Eastern UP region. Still we are trying to figure our way out in Western UP and did some good work in Punjab. With all the distribution changes what we have done in South India, it will take another 1 or 2 months to stabilize. So the 3 target markets are basically UP, Punjab and Southern India.
Okay. Any newer geographies apart from these 3 states or that you are planning to enter?
There are few smaller geographies which we are also doing right now, like Uttarakhand, but the main concentration is on UP, Punjab and Southern India.
Okay. And finally, sir, any status on the Kolkata plant fire insurance claim, anything on that?
Kolkata, with respect to Kolkata fire, we are expecting surveyor to submit the report by end of this month to the insurance company.
Okay.
Then we'll get the communication from insurance company. Thank you.
Sure. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question at this time. The next question is a follow-up from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Thanks for the opportunity. I think on the telecalling front, we have seen decent success in some of the geographies where we had implemented this. So have we implemented it across geographies, or it is yet to be implemented? It is still implemented in some of the areas.
We have implemented in very few geographies, probably around 10 cities in the country right now. Hardly 10% of the sales come through telecalling. With all the changes in the distribution model and removing the super stockist, that activity has been put on hold for some time. We will restart it probably another after 1 or 2 months. But we are currently operating only almost 10 cities in the country.
Sure. And sir, just wanted to reconfirm that the additional saving that we can get by eliminating super stockists. I think you had said that we can save at least 2 to 3% on the margin front. Is that the right statement to make?
Yes, definitely yes.
Sure.
On the channel marketing, by increasing the PTR, we should be able to save anywhere between 2 to 3%.
Sure. And sir, on the grammage reduction front, how are you seeing some of our larger competitors like Lay's or Frito-Lay and some of the large regional competitors like Balaji? How have they reacted to such unprecedented rise in raw material prices? How much reduction have they done on the grammage front?
The grammage reduction has been done in the line of the competition only. it is very difficult to reduce grammages on your own. But because of the higher raw material prices, everyone has reduced the grammages. We have also done that. And it is in line with the competition, not aggressive in reducing the grammages. We are more aggressive in reducing the channel margin than reducing the grammages. That is the last resort for us always.
Sure. So, but the competitors have also reduced grammage significantly.
Yes.
Okay. Thank you, sir. Thank you.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Rohit Balakrishnan from iThought PMS. Please go ahead.
Hello, sir. Am I audible?
Yes.
Yeah. So this is again the question on your channel margin that you have reduced. So I had a question on this. So I mean, were these channel margins high in the past? I mean, compared to your competitors, or if they weren't, then I mean, don't you expect any sort of impact on your sales because you will be now offering lower channel margins? Just wanted some clarity on this.
So if you see the competition, most of the players are basically big players, but they are regional players. Like there are few very big players in Gujarat, few North Indians in the Western India, but they are supplying in their own geographies. So their channel margin was always lesser. The channel margin was almost between 8 to 9%, and we were offering some 12 to 14%. We have been able to reduce the margin because we have been started producing at different locations, at different third-party locations across the country. Now we have plant in Northern India, Western India, South India, across the country. So we were inefficient compared to our competitors. With these new changes, we have become little competitive in that segment.
Okay, got it. Oh, understood. So in that sense, I mean, the distributors that you were working with, they were earning more from, they were getting more margins from you, but now they'll be at par with, you'll be at par with others. Is that the right understanding?
No. We haven't reduced the distributor margin. The distributor margin is same. We have reduced one layer in between. So if you take example of Bombay, we have two super stocks which probably were supplying Western and Central India, and they were supplying to distributors. Now, most of the Bombay we are directly supplying to the distributors. So there is an extra cost involved as a super stockist margin and the onward freight, which is the cost for the super stockist to supply to the distributors. So we are trying to save on that margin. We haven't reduced the distributor margin.
Understood. Okay. So, just again, maybe a very basic question, sir, but is this the way the industry is like your peers are structured, or this is something that you're doing very differently from the peers?
I think in the national, if you talk about the national player level, probably we have done it very different compared to all others. But if you talk about regional players, they were always directly distributing because they were operating in a 300-400 kilometer area.
Okay, got it. So basically, what you're saying, sir, now because you have a much wider geographic footprint, you can do this because it will be much more efficient versus having a multi-layered structure. Is that the right understanding, sir?
Definitely, yes.
Got it. That's helpful, sir. The second question was, sir, if you can talk a bit about your sweet portfolio, the confectionery and that part of the portfolio. We had targets of increasing that. How is that shaping up? If you can just share a bit on that.
The sweet snacks have been doing okay for us, not that good as we planned. Unfortunately, the COVID has hit that most because they were primarily targeted towards the kids only. So we are revamping that. We have just launched recently one more product by the name of Swift Roll, which is doing good for us. I think it will take another 1 or 2 quarters for us for the sweet category to stabilize and grow.
Okay, so what is the percentage of sales that sweets contribute at this point of time in FY22, sir?
I think it's between 3.5% to 4%.
Got it. And
we take it to 7 to 8%, but they are far away from that right now.
Sure. And assuming obviously there are no disruptions going forward, where do you intend to take it to 8% in the next 2-3 years? Is that a fair assessment, or will it take more time?
7 to 8% is the target for QTS Max.
In the next 2-3 years?
Yeah.
Okay. Sure, sir. I'll join back in the queue if I have more questions. Thank you very much.
Thank you. Thank you.
The next question is from the line of Nilesh Shah from Envision Capital. Please go ahead.
Thanks for the opportunity again. I have a follow-on question in terms of our capacity utilization. So just want to understand that currently what's the kind of capacity we have? Where do we think we can basically take the capacity utilization to, and what would that mean in terms of revenue potential from our existing facilities? And then, of course, we're doing a fresh investment as well under the PLI scheme. So how much can that potentially add to our revenues over a period of time?
So the current utilization is roughly around 60% on a blended basis. However, there are multiple manufacturing facilities. So for individual plant, it may vary. It ranges from 35-40% to say 85%. Under the PLI scheme, we are committed to invest around 85 crore during the current financial year, and we are planning to put up some plants. One plant we are planning to put up in North India, as UP is the target market for us. We are planning to have a facility in North India for namkeen and extruded products. We put up a plant in Calcutta. However, it caught fire. Again, we are restoring the same facility and investing in the same plant. In near term, we are also planning to have one plant in South India, because currently we have one facility in Bangalore and we have 3P operation in for potato chips. So we are planning to put up another plant in South India.
Okay.
I think with this capacity investment, we will be good for next 2 to 3 years time in terms of fresh investment for capacity expansion.
Okay. So just, over the next, say, 2 years, if I were to kind of look at FY23 and FY24, what would essentially be the total capital outlay or our capex plan over the next 2 years? And would we have enough cash currently to do that, or we would need to resort to some more borrowings? If you could just basically walk us through the funding plan as well.
Sure. So as I said, in the current financial year, we are targeting capex roughly around 85 odd crore.
Yes.
And with this, we'll be good for next 2 to 3 years capacity requirement. For FY24, we would need some maintenance capex that includes replacement of some old machineries and some capital investment for vehicles, which is not part of PLI. So for FY24, there won't be significant capex, but on a conservatively, we can assume somewhere around 20 to 25 odd crore. So both put together 100 to 110 crore for next 2 years would be the capacity investment for the capex.
This will include both Kolkata and Bangalore.
Yes, yes, everything.
Okay.
Currently, we have around 65 crore free cash. So we don't see any requirement for borrowing for capex. That can be done with the existing cash available and the internal accruals.
Okay, fine. Thank you so much. Thanks.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Thank you very much, everyone, for taking out the time and joining our conference call. Thank you so much.
Thank you. On behalf of Prataap Snacks, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.